Okay.
All right.
1, 2, 3. Amazon. Amazon.
All right, the company we chose to analyze is Amazon. Amazon was originally founded by Jeff Bezos in 1994, with its official name being Cadabra. The name was switched to Amazon Incorporated just a few months later. The website was first published around a year after the company's launch as a book-selling website that would deliver to all 50 states. Amazon began selling things beyond books in 1998, hoping to become a profitable company. The first profitable year was 2003, when they saw their net profits rise nearly $70 million by December, earning them $35 million in total profit for the year. The company then launched one of their most profitable services, Amazon Prime, in 2005. Amazon saw their total revenue grow by 11% in 2024, up $63 billion. North American revenue grew 10%, and international revenue grew 9%. Their operating income improved by 86% in 2024, and they went from an operating margin of 6.4 to 10.8%. Amazon falls under the electronic shopping industry. Amazon dominates this market with other leading companies such as eBay and Shopify. Because Amazon provides such a wide array of goods and services, they are subject to a good amount of competition from other e-commerce businesses, retail businesses, publishers, advertising firms, healthcare providers, etc. While these competitors exist, and in many cases do affect Amazon's sales, Amazon remains dominant in most of these industries due to convenience to customers. Compared to other companies in the online industry, Amazon is the largest and one of the most profitable. It is also one of the oldest. Online shopping is still a relatively new norm starting in the 1990s, making Amazon one of the first official online retailers. And some potential disturbances to this industry include supply chain hiccups, tax laws, and other economic factors, many of which people around the world are experiencing today.
And then talking about corporate governance analysis, the CEO of Amazon writes to their shareholders each year going over total revenue, operating income, cash flows, any updates the company has about products, and always has the 1997 original letter to shareholders because that's what they say is still true now. Management implies in the shareholders' letters in 1997 that they focus on long-term of the company itself, and that's still true. Management has annual meetings, and the decision-making is mainly people with huge amounts of money invested. In terms of ownership, the ownership of Amazon is mainly Jeff Bezos, the CEO, but the ownership is pretty spread out in terms of actually having 4 committees, 12 directors, and 7 officers. A potential conflict that has come up actually recently is the labor practices. On December 13th, 2024, there was a strike that Amazon workers went on outside of a warehouse that has a union. Workers felt as though they were not being heard as a union. The workers wanted more respect and care from the company, which later Amazon attempted to overturn the ruling from the National Labor Relations Board, but failed. Overall, Amazon should respect and listen to their employees so that there's not any more protests or further loss of employees. In terms of corporate social responsibility, the firm handles its corporate social responsibility with sustainability efforts by promising to have zero carbon footprint in a few decades. Amazon is known as the biggest company to purchase renewable energy on a global scale. Amazon manages its image by appealing to its customers through sustainable methods. The firm has also tried to support its employees better by contributing to large amounts of money to the Housing Equity Fund, which provides people with affordable housing. Amazon is perceived as a company that gives back to the community, including the employees, to provide a better life for people.
I'm Nick, and I'm going to be doing the risk and return. Amazon's risk and returns mostly reflects on its position as a global e-commerce platform. Since it is a leader in that space and can leverage its unrivaled scale, I do not believe that Amazon contains an abnormal amount of risk for the average investor. There are some points of concern that arise specifically within the market, firm, and currency risk for the company. These include intense competition in e-commerce and cloud services, regulatory scrutiny, and shifting consumer preferences. And then the firm-specific risk is that for heavy investments in fulfillment networks, AWS infrastructure, and international expansion. AWS is Amazon's service for building web pages. 27% of their net sales from international segments exposed earnings to foreign exchange fluctuations, meaning that if the currencies associated with these foreign exchanges devalue, then that would be bad for its stock price. With all these concerns, Amazon still managed to beat the estimated 7.8% for their most recent fourth quarter, clocking in at 11.8% according to Morningstar. This is good news for those who have money in Amazon, as they are now projected to have higher percentages in the coming quarterly reviews. How this risk profile is changing. There is increasing regulatory pressures, and they are expanding antitrust investigations and compliance demands in the US and EU. It is believed that with these new compliances, it will be harder for Amazon to expand internationally, as it has to balance all the different judicial systems of the world. Rising financial leverage. There's an $8 billion term loan in 2023 and growing debt sitting at $52.6 billion as of 2024. And that signals higher financial risk. However, it is believed that this debt comes from Amazon's increase in facility expansion and growth over COVID. According to Morningstar, that debt number should become smaller as these expansions begin to become profitable. Mitigating factors. They have diversification into high margin areas and improved operating margins. They had 11.3 in quarter 4 versus 7.8 in 2023. So for the historical returns and the market comparison, as of April 2025, Amazon trades at $171, and that is below Morningstar's fair value estimate of $240. Over the past year, it has ranged from $151 to $242. So if you were to have invested at the beginning of 2025, you would be in a loss with the money that has been invested. It underperformed the S&P 500, which has a 10% annual return. It has higher volatility, and it reflects its growth stock status. This company's equity is not risky. The company has quite a sizable market presence. It is one of the world's largest company with a market cap of approximately $2 trillion. The cost of equity is higher than average. Amazon's cost of equity is higher than that of mature, low volatility companies like Walmart, but that is reflecting its growth orientation and greater sensitivity to market swings. The cost of capital is Amazon's weighted average cost of capital is estimated at 8 to 9%, and it is balancing its low debt cost, which has a strong credit profile, and its high equity cost. Morningstar notes that there is a 2% free cash flow yield, suggesting that the current stock price reflects moderate risk relative to growth prospects. In conclusion, Amazon's equity represents a blend of growth and risk. It trades at a premium to peers, and is justified by its dominant market position and strong growth drivers, specifically in AWS and advertising. This stock is considered undervalued by several value models, and analyst sentiment remains bullish despite heavy volatility and heavy capital investments. Investors should expect continued share price fluctuations, but strong long-term appreciation potential, provided Amazon's maintain its leadership and innovation trajectory.
Okay, so the evolution of Amazon's financial performance. They went public at $18 per share in 1997. Average share is now around $207 as of 2025, and it currently is around $189 that I last checked. They turned their first large profit in quarter 1 of 2001 at $5 million. Prime launched in 2005 and really began expanding in 2010, which drove sales from $34 billion in 2010 to $280.5 billion in 2019. The earnings per share, it has faced some dips, but it has steadily increased from 10 cents in 2009 to $4.78 in 2024. They ended 2024 with a debt to equity ratio of 17.5%, which is a 37.9% decrease from 2019. The capital structure and payout policy. So throughout the lifetime of Amazon, it has never paid out dividends, and therefore it retains the majority of the earnings, which means there's more funds to invest in new infrastructure and products. They have an aggressive reinvestment strategy. They have historically reinvested more than they profit to fuel growth, innovation, and expansion of the company. As of 2025, Amazon has a debt to equity ratio of 17.5%, and the ratio continues to improve, showing they have a healthy capital structure. Amazon has illustrated conservative debt use over its lifetime, but saw an increase in leverage from 2018 to 22, just due to expansions, inflation, market pressures, and the pandemic. Amazon has consistently avoided over-leveraging and utilized majority equity during early growth, and they have maintained strong investor confidence, which allows them to issue bonds at lower yields. So some of Amazon's typical projects, they are mostly long-term, like about 10 to 15 years. They require high capital upfront, but they're intended to generate long-term stability and cash flows. Many projects have been investing in logistics. They invested in Kiva robotics system to improve efficiency in facilities. They also invested in AWS Global Infrastructure, which is a cloud computing platform, in 2006 and is now one of Amazon's biggest drivers for their revenue. They bought out Audible in 2008 for $300 million. They bought Twitch in 2014 for $970 million, and they bought Whole Foods in 2017 for $13.7 billion. Their current projects, they're currently investing a lot in renewable energy. They have over 500 solar and wind projects around the globe, and they are the largest corporate purchaser of renewable energy for the 4th year in a row. They are working to have renewable energy power 100% of their facilities. They're investing $4 billion in rural America to expand delivery network and create more jobs. They've been investing in data centers, and they've invested $8 billion in Anthropic, who are working to develop AI platforms, and an AI language model called Claude, which is with AWS as the primary cloud and training partner. They've been investing in satellites. Their projects are heavy upfront capital, focused on long-term development and gain. They're intended to boost Amazon's revenues, competitiveness, efficiency, sustainability, and customer experience. Investing in projects to advance AWS, which is a large contributor to their revenue. Their current projects are long-term developmental projects and demonstrate Amazon's ambition to innovate and expand across numerous sectors. Their future projects, based on past and current projects, Amazon is likely to continue its steady growth. Their projects in the future are more than likely to look like their current and past projects. Amazon focuses most of its projects around developing new and improved technology, and they quickly adapt to what is up and coming, like AI, for example. Therefore, Amazon's future projects are most likely to resemble the same wide-scale, ambitious, innovative, and capital-heavy projects in the future.
All right, so my name is Allison, and I did capital structure choices. So for raising funds, Amazon went public in 1997, and even with overall shifts in their debt-to-equity ratio over time, has been primarily funded by shareholder equity. Amazon has used debt to fund itself, notably when making purchases of other companies, including Whole Foods in 2017. They've also used loans and debt to fund big projects, including drone delivery and the creation of Alexa, and more recently, AI. All right. For the debt and equity makeup of Amazon, Amazon will use debt when they don't want to rely completely on shareholders to increase their capital. They do not want to create more shares in the company, which would essentially spread ownership out. After analyzing annual reports over the years, it is clear that the years of big growth and innovation, i.e. 2017 where they purchased Whole Foods, or 2000 where Amazon expanded its domain, Amazon debt-to-equity ratio increased, which shows that they're financing more heavily based on debt. And they currently have a debt-to-equity ratio of 1.1, which means that for every $1 that Amazon has spent, they have 1.1 in debt, which is relatively low compared to other companies. All right. For my quantitative advantages and disadvantages, here are my numbers. For my total debt, Amazon has $130.9 billion. And this number may seem large, but companies like Verizon and Comcast still have a bigger debt than Amazon, even though they're quite smaller. Their debt to equity ratio is 1.1, as per explained in the previous slide. Their cost of debt is a 3.9% annual return. Cost of equity is 10.07 annual return. This shows that debt is lower risk for lenders to Amazon, and equity is higher risk to shareholders, which would lead to more reward for Amazon. WACC is lower than the cost of equity, which is really good for the company. This shows investors that Amazon is overall healthy, and even though the risk for a loaner is lower than the risk for a shareholder, this low WACC value will prove to potential investors that it is safe and beneficial to invest, hence further showing why Amazon is primarily funded by equity at the moment. A risk or disadvantage of the current capital structure is debt is also risky. So if they were to increase their debt and something were to happen to the economy, Amazon could be left financially struggling, even though they're currently a sound company at the moment. All right. For my opinion on if Amazon has too much or too little debt, right now, especially with Amazon's low debt ratio compared to the past, I believe Amazon could err more on the risky side and finance more with debt. This could lead to more funding for future innovation in products and services, investment in value-based customers' concerns like making it a green company, and more shareholder control in Amazon stocks, which would amp the price of stocks up and really help the company overall. And as with increased debt, there would be less complete reliance on stocks to fund their overall projects. Overall, even though debt financing can be more risky, I think Amazon has proved how they have successfully used debt financing to build a very successful company and innovate new projects in the past, so I think they could do it again.
So Amazon's dividend policy is that it does not pay dividends. It has never paid dividends, and it very rarely has buybacks. It has bought some back stock, but rarely and significantly less than other companies. It prioritizes investments rather than buybacks, despite some investors hoping to receive dividends, especially since Meta and Alphabet companies just started giving dividends to their investors. I do believe that these dividends would be an incentive for more investors to come through. So personally, I think Amazon should start giving dividends to their investors. So when it comes to valuation, Amazon is and has always been a growth company due to their high growth potential. Despite having a significant amount of investors, it is likely that Amazon's high growth will last for a long time due to factors such as competitive advantage, online marketing dynamics, and internal capabilities. Amazon has a significant competitive advantage compared to other companies in their industry due to their convenience and brand preference. These factors also play into their marketing dynamics. Amazon is one of the main places customers go when they want or need a wide variety of things and they need these things quickly. Amazon has built up a decently reliable reputation, providing high quality products quickly, which in today's society has proven to be a valuable asset to the company. Customers now choose Amazon because of its reliability, convenience, or out of habit. Amazon's ability to put themselves at the forefront of the online shopping industry has made customer online marketing dynamics work in their favor. Finally, because Amazon has been a leading company in their industry for so long and have spent all of that time developing and improving their internal capabilities, they have a significant advantage in this aspect. All of these factors indicate that Amazon is and will remain a dominant competitor in their industry and will allow them to continue in their high growth stage, thus increasing their value. Okay, Amazon reported that their total stockholders' equity as of December 2024 was $285.97 billion, and this is a 41% increase from 2023. The market capitalization number is significantly higher than their stockholders' equity, as this would be the total number of their outstanding shares, which is 10,593,000,000, multiplied by their current price share recorded in their annual report from 2024, which is 111, roughly making their market capitalization $1.75 trillion. This means that the book ratio for Amazon is 6.12. Essentially, Amazon's market value is 6 times higher than its book value, causing investors to expect higher returns and higher levels of future growth. Okay. And then my opinions on the 3 big things that Amazon could do to improve their value is that if I were Amazon, the primary tactic I would use to increase the value of this firm is to continue investing in new technologies to increase the efficiency and thus increase convenience for customers even more. Increasing convenience and efficiency will increase profits because new and existing clients will be more inclined to choose Amazon the next time they're shopping. The second tactic I would recommend Amazon utilize in order to increase their value is to implement a small dividend for new and existing shareholders. With other prominent companies beginning to do this for their investors, I believe it will be a critical step for Amazon in the future to increase the company value. Adding small dividends to shareholders will draw in more investors into the company, thus increasing the company's overall value. Finally, I believe that expanding Amazon Prime into more countries is crucial. As the online shopping trend goes, as does the market potential for Amazon. Expanding Prime into more areas around the world may seem costly initially, but as access grows, so will sales and membership purchases, thus increasing the company's value.
All right. So for our conclusion, Amazon is a company that focuses mostly on long-term growth and prosperity. They have increased competition in the company's biggest risk. Otherwise, they are firmly a leader in the industry. Their financial performance is consistently growing and improving over time. Their projects focus on long-term effects and require high capital, including debt. Currently, Amazon is attempting to improve sustainability through renewable energy and focusing on expanding into rural America. They use equity primarily for financing and rely on it more highly than they do debt at the moment. They don't use dividends that are offered to investors, and Amazon is a growth company and will likely continue to foster innovation to grow its value. Overall, for investors, Amazon is a very safe company and consistent company to invest in. Even though they have a high equity ratio, they have time and time again proved that to shareholders that the opportunity for gains is substantial. With this consistency and planned projects for the future, we would highly recommend investing in Amazon. Thank you.
Thanks for listening.
Thank you.
And this was Amazon. Bye-bye.